I'm Jerry Slusiewicz, host of this program, the Money Talks video updates. Today is December 8th, 2011. We're getting close to year end. The markets have staged just tremendous volatility over the second half of this year. It's been downright incredible. Bear with me as I read this. Since July 27th, there was an 18% drop in the value of the S&P in a 3-week time frame, bottoming out on August 9th. Then from that intraday low on August 9th, by the end of August, it shot up 11.7%, the S&P 500 did. Then the S&P plummeted again, this time down 12.6% in just over a month, bottoming out again on October 4th. Before October was over, about the 27th of the month, it had a 20% rise from the bottom of the 4th to the peak on October 27th. Still not back to where the July highs were, though. Then it fell another 10% in the following 4 weeks. Since the low on November 25th, the market's risen 9.3%, topping out this past Monday on December 5th. And here we are. We've been going sideways this week, only to start selling off today on, again, December 8th, the day before the next European summit. The European summit tomorrow will be the 8th incantation of the Eurozone 17-country meeting, trying to bail out that zone with the massive debt that has been accumulating and really weighing down on Europe over the last 2 years. It's been a 2-year problem that they're trying to deal with. The problem is unless the ECB, the European Central Bank, comes in and starts buying bonds, I don't see how they're going to come up with some resolution. I know they want the IMF, the International Monetary Fund. The International Monetary Fund is partially us here in the United States. I don't think we here as Americans with our own debt problems want to be bailing out Europe. So the Germans and the French can't seem to agree. Those are the two big countries, but they also have their own debt problems as it stands, with Germany having a debt to GDP ratio of around 80% debt to their GDP. These are extremely high historical numbers. Generally speaking, the market rallies into year end. We get that Santa Claus rally in the final weeks of the year. This is historically the best time of the year to be an investor, but the markets have bounced against their 200-day moving resistance, the S&P, the NASDAQ, the small cap Russell 2000 index, the mid cap index. They've all been bouncing against the 200-day moving average. Now, with a little pullback, are we going to hold only to bounce through that resistance and get that year-end rally that many people, most money managers, want? Or are we going to fail at that resistance and then see and test the November 25th lows? And if those don't hold, that means we're going back down to the October 4th lows. We're at a crossroads here. I don't know the answer. We are invested on both sides of the market, hoping for a positive resolution to the dilemma, but we're holding very tight stops. We own certain areas that own income. We're even seeing problems in the gold and gold mining stocks area. We're still long them, but there's potentially a devaluation, a recessionary environment coming if things don't work well. The one positive, or another positive that we see out of Europe, is the fact that the bond interest rates have dropped dramatically for both Italy and Spain. That's a good sign. That's hopeful that there'll be some positive resolution. It's really important that you not just blindly hold and hope. It's important that you look at each and every position and measure how you've done year to date and line up each position from your best performer, next best, to your bottom performers, and understand how they've done relative to your portfolio and relative to the market. It's always a good idea to trim back and pare your losses and losing positions that haven't done as well as some of your other positions. Either add to your winners or find new areas in the market, or maybe even sit on the sidelines temporarily, waiting for the market to resolve itself and determine which way it's going to go. It's important to use stop losses as protection, to some sort of an exit strategy, knowing what's the worst possible case for each investment. We all buy and invest for the best possible outcome. We want it to work out. We want it to go up in value. But what if it doesn't work? You need to have a plan for two outcomes, the good and the bad, and determine in advance what's the maximum amount of risk or amount of money you'd like to risk on any one position. If you need help on that, call me, Jerry Slusiewicz, 800-449-9501, or sign up for our free email newsletter right here on the web. All we need is your email address. We send out pretty much weekly updates, either in writing or via podcast. And we update the videos as often as we feel necessary to keep you posted in terms of where the market's going. We're hopeful that the markets just go down here a little bit in the next day or two. We get the resolution from Europe. We get a pop next week that lasts into the year-end rally. We clear the 200-day moving average, which would spur a buying spree where people would have buy stops and there'd be shorts covering, and we finish the year around 1310, somewhere around there on the S&P. May not happen though. We're prepared for that outcome as well with very tight stops. Again, I'm Jerry Slusiewicz. Sign up for our newsletter. Give me a call toll free, 800-449-9501 to have your free no obligation portfolio review today. Have a great time investing.